A lot of people assume you need thousands of dollars to even think about investing in the stock market, but that actually isn't true. A small sum, just $100, or about 9,500 rupees, is enough to get started. That exact amount is mathematically enough to buy you tiny ownership slices of the biggest, most aggressive technology and healthcare companies in the world. The trick is changing how you view that money. Instead of treating it as pocket change to spend on a nice dinner, you treat it as a financial seed that you are planting. Because you are starting with a small pool of capital, you have to be highly efficient. You need a setup that doesn't charge you high entry fees and keeps ongoing costs extremely low, giving your money the maximum room to grow. The absolute size of the cash you begin with matters far less than the structural environment where you plant it today. If you are investing in the Indian market, the best way to plant 9,500 rupees is through a mutual fund. It takes your single seed and splits it into dozens of roots, letting you own parts of many high-growth companies simultaneously. This document outlines a Flexi Cap Fund strategy. It acts as a strong foundation by dynamically moving your money across companies of all sizes. Looking at the dominant sectors and top holdings, it even gives exposure to major international tech giants. Small cap funds target aggressive market disruptors, though the text notes this volatile class requires a multi-year hold. But you don't have to choose just one path. This framework shows how to split your capital into aggressive wealth acceleration and steady, balanced market leaders. When you invest in smaller companies, you will experience volatility. Think of volatility like a strong wind blowing against a young tree. The branches might bend and thrash around, which looks scary. But if roots are spread wide across different sectors, the tree remains perfectly safe.
To make sure every bit of your money goes straight to work, you want to choose what are called direct mutual fund plans. This simply means you buy straight from the source, cutting out the middlemen who would otherwise take a cut of your investment. By combining these direct funds, you instantly build a wide-reaching, fast-growing portfolio in India without needing millions of rupees to do it. If you are looking at the United States market, a $100 budget faces a different hurdle. Traditional investment funds there often require thousands of dollars up front just to open your account. To bypass high entry barriers, we use exchange-traded funds, or ETFs. These pool massive amounts of money into large baskets of stocks, allowing everyday people to buy tiny, fractional slices of the whole basket. It removes the need for thousands of dollars up front. This page breaks down excellent ETF options. The Vanguard Growth ETF is a low-cost vehicle buying into massive American enterprises. Looking at the top holdings, your fraction of a share gets you immediate ownership in companies like Microsoft, Apple, and NVIDIA. Another powerful tool is the Invesco NASDAQ 100 ETF, or QQQM. It tracks the largest NASDAQ companies, but is optimized for regular investors with an identical asset architecture at a cheaper fee. This guide recommends a precise approach for your $100. By splitting your capital evenly, 50-50, across both of those funds, you create a perfectly balanced mix of broad market growth and highly concentrated technology. Once your money is planted in these funds, it begins compounding. Compounding happens when the money your investment earns starts generating its own additional earnings. It is like a tree dropping a seed that immediately grows into a second tree, rapidly multiplying your original effort. Whether you are planting your seed in the Indian market or the US market, the mechanics are identical. You buy fractional slices of dominant businesses and let time multiply your money. There is one hidden threat to your growing financial garden: the structural costs and management fees that get deducted from your account. These costs are known as expense ratios. An expense ratio is the annual percentage the fund manager charges you to run the fund. If that percentage is high, it acts like a parasite, silently draining the momentum of your compounding money year after year. This comparison table shows exactly how to protect yourself. By strictly choosing direct mutual funds in India, which sit around 0.60%, or ultra-low-cost ETFs in the US, which drop all the way to 0.04%, you shield your investment from those administrative drains. Keeping those ongoing costs as close to zero as possible is mathematically vital to your final wealth. When you look past the daily news and short-term bumps in the market, the real magic happens over a 5 to 10-year horizon. Over that decade, your small initial capital transforms.
Because the underlying businesses you own are constantly working, selling products, and expanding, your initial seed grows into a self-sustaining engine of wealth. This entire process is passive. You do not need to sit at a computer trading stocks every day. It demands structural discipline upfront and long-term patience. The $100 or 9,500 rupees sitting in your bank account right now is a dense, highly productive financial forest, simply waiting for you to plant it.